Hi, welcome to the Weekend Investing Daily Bytes. It is May 26th, and we had another lackluster sort of a day in the markets today. Uh, Nifty was slightly up 0.6%, and the broader market was also gradually up, although banks were a bit sluggish from the start. Um, Within the sectors, IT sector was up nicely. This is despite the rupee strengthening. So there is very strong trends underneath the uh, the IT move, and if rupee were to stop strengthening and start weakening, this could uh, go up further. Uh, Autos, consumption, pharma was slightly up, nothing really great. Metals and public sector enterprise were taking a beating. So it looks like profit taking and sort of lethargy in the market in terms of trying to uh, go for a new fresh momentum leg up. So it's sluggish, but it is still positive. So let's see how things may pan out in the coming weeks. Um, in terms of our weekend investing strategies, all the small cases were also reasonably range bound. NG 50/50 was a very nice starter today, almost up a percent. This is a free small case that we have, which invests in Nifty Bs and Gold Bs. So it is a balanced portfolio of these two ETFs. And over a long period of time, we have seen that it has given a CAGR of more than 11 or 12%. In the last 5 years, it has given 13% plus. So it's a great sort of almost like an all-weather sort of portfolio where gold and Nifty are very inversely correlated. So, in 2008 also, in 2020 crash also, we've seen how gold is able to give a very good counter hedge to the index or to equities. And this combination of these two really helps in having a very smooth equity curve. If you go to this particular small case, you can see the equity curve on that chart. Topic of the day, continuing from yesterday, is how to not lose money in the markets. Very simple sort of commonly trappings that most people have experienced with, or they are essentially every other stock or person that you talk to would have experienced this. So this is nothing new, but we still want to overemphasize these traps in the market, so that in case you are falling in this trap, and even though you probably likely know that you're falling in a trap, but because of your psychological situation, and you've studied so much about that particular stock, that you feel compelled to hold on and sort of not break that marriage. So while these are very sort of basic and simplistic concepts, however, as many times as you can beat it back into your head, that you don't want to get stuck in this trap, it is good for you actually. So just a story that we were following from Twitter this morning, where we posted that if you bought a stock at 200 and stock has come to 100 because of XYZ reason, then we're saying, okay, let's wait for some more time. Let's be more patient. Everything seems to be good in the market about this stock, fundamentals, management quality, FII holdings, everything is fine. It's just happened to drop 50% or whatever, but it's a fantastic company. The growth runway is huge. It has this and this moat, and let's wait and watch. So now a lot of people don't think about it, that there are these drawdown. So drawdown is basically the fall from your maximum point to your lowest point. So this is a 50% drawdown going from 200 to 100, and a lot of people don't see it in percentage terms. So they see it in absolute terms. 200 का 100 हो गया. 200 has gone to 100, and when we'll go back from 100 to 200. But it doesn't work that way in maths, right? So 200 to 100 is a 50% drop, but 100 to 200 is a 100% gain. But somehow we are unable, or at least most of us are unable to appreciate that fact that in percentage terms, the more deeper you go in the hole, the more difficult it is to get out. So it is like quicksand. This, he's not flying, actually he's trying to get out of the quicksand. Uh, so 200 to 180 is a 10% drop, but you need a 11% recovery to come back to your original point. 200 to 160 is a 20% drop, but you need a 25% recovery. 200 to 120, 40% drop, you need 67% recovery. 200 to 60, 70% drop, 233% recovery is needed. And Yes Bank has done even worse than the last one, for instance. 200 to 20, I think that is 400 to 13. A drop of 90% here, 200 to 20. And you need 900% gain from there to come back to your original position. That is the kind of quicksand these drawdowns are. And the basic idea being that you need to be conscious about these drawdowns, not only on a stock basis, but also on a portfolio basis. The same thing will happen in the portfolio also. If your entire portfolio is down, let's say 40%, you will need 67% gain on the entire portfolio to come back to break even. A stock may still bounce around easily, but an entire portfolio, which is made up of so many stocks and possibly other asset classes also, to go back that kind of return is very difficult, because that would mean that the entire portfolio makeup is such that all things move in tandem to give you that 67% boost from minus 40. It's a very difficult position to get out of. So you need to be very conscious about what strategy you are following, how far do you want yourself to go into that quicksand. Because once it goes below a certain threshold, it is very difficult to get out. Unless you throw fresh ammunition at it. So that would mean more capital or some other new strategy, which again is anybody's guess how that may work out. So just to give you more example and a conceptual idea about how this has worked in our portfolio, for instance. So this MI25 is a small cap 25 stock portfolio that I run. It has been running live now for more than 5 years. So we invest in 25 small cap stocks and we start at 4% allocation to each stock, right? So we started here in April 2016. So this yellow line or the golden line is the small cap index, the CNX small cap 100. That is the index. And this blue line is the equity curve of the MI25 portfolio. So this portfolio has been running live, and these are the actual sort of equity values. Now let's see what happened. April 16 till about January 18. So about 1 year and 3 quarters, the small caps did very well. So index went from 100 to almost 196, let's say doubled. And the small cap portfolio went from 100 to 319, almost tripled. Right, so huge outperformance on the up. Now what happened? Small cap party crashed. January 2018. A lot of people got trapped in our MI25 also, but only for transient period. Let's see what happened here. From January 18 to March 2020 was sort of the worst fall, almost the worst fall. So small cap index went from 196 to 69. A drop of 65% on the index. Can you imagine? Individual stocks may have gone 90-95% down also. So 65% drop here, whereas because of better strategy and ability to go to cash and better stocks in hand, the portfolio of 25 stocks went from 319 to 227 at the lowest. The lowest actually came much before the low came in the index. So while the index dropped 65%, MI25 dropped 29%. There's a huge difference right here. So outperformance on the upside and outperformance while coming down. Can you see the difference? Now what happens? Now you are down 65% here and you want to build back to 196. That is a recovery of 184% that is required. A gigantic task, right? But as luck would have it, the market got 2021 move and it is almost there now, right? In about just over 1 year and a few months, we are almost near the starting point from the top with a 184% recovery was required. Once we reach there, we would be at zero gains from this point on the index. Look at what has happened in the portfolio. As this bottom was made and as this leg up came, strongest of the strong small cap stocks were selected and we were sitting on them. And just look at where it has reached. It has reached 586 from 227. Almost, I would say, 140% up from here. Right? It needed only 41% to reach the original point, whereas here you needed 184%. So overall, over a 5 year and 1/4 period, 100 went to 187 on the index, 100 went to 586 on the portfolio. All this has happened only because this drawdown was shallow. If this was equivalent to 108, this 65% drop, this outperformance would be much lower. It would probably be just about somewhere here only. But because you are able to get out of quicksand quickly and you are ready to take the next flight up, so you had to cover less distance in going up, and you avoided that huge bloody pain that happened from minus 29% down to minus 65%. So I hope this example will drill through you the importance of drawdown and how shallow drawdowns can help you recover very quickly. They can help you remain psychologically positive. I mean, once you're down 65%, the best of minds start to break down and not believe the recovery or the potential to go back. That is the impact of the negativity a drawdown will get you. So not just the returns, it is also the positive frame of mind that a shallow drawdown will hold for you, so that you can recover quickly and go further up. So this is all I had for this small daily bite. Thank you so much for your kind comments that you are daily writing to me. We are hosting a webinar this Saturday to resolve all issues for the Smallcase users. So please go to the Telegram channel. The link is there, and fill in your queries that you wish to ask. We'll try to get as many queries answered as possible. Also, we've put up a weekend investing hub pages there, which is inclusive of all the products, all their features, all the performance, everything at one place, so that it is easy for you to compare and add more to your arsenal. So take a look at that and send us more suggestions or feedback as you always have. Thank you. Goodbye.